I'll just start the recording there. Yeah, so Steve Griffiths here, developer of the MTPredictor software program. If you could all just let me know whether you can hear me okay and whether you can see the MTPredictor in the background and the risk disclaimer at the start. Right, which reminds me, let's go through the risk disclaimer and just remind you that all examples in this training room should be considered as hypothetical. No trades are actually taken, they're just shown for illustration and training purposes only. Remind you there's a risk of loss in trading and investing. Put another way, all professional traders know and understand, but more importantly, accept that losses can and will and do unfold. Doesn't matter what trading approach you use to the markets, there always will be losing trades. That's just a fact of life. Right, so a few things I want to go over today's webinar. Today, I'd like to start with looking at our risk rewards and our position sizing. I had a good question from Kevin, so I can see you in the webinar today. So good morning, Kevin there. He asked a good question on position sizing on longer term trades, for example, using end of day data using US stocks. I'd also want to then come on to the USE minis and have a look at a good example of our VS or volume spike setup from yesterday. We haven't looked at our VS setup for a while, so I thought it'd be a good one to go through. And I'm guessing we'll have a quick look at oil, particularly after the events that have been going on over there in Saudi Arabia. So we'll look at that a bit later on as well. I know quite a few of you follow oil. Right, so this is our standalone version, and this is using our end of day data feed with Norgate data. And these are just daily charts. I've got a scan there of the NASDAQ 100 and a scan there of the Dow 30. So what I want to look at is the position sizing when you're using perhaps longer term charts. Now, if we go to tools and accounts and risk, and we come over to risk profiles, here we have our percentage risk by our asset class. So if I come down to stocks, you can see initially I have set here 0.5% risk for each trade. So what does that actually mean? Well, let's have a look at a potential setup here on Cisco. So the TS3 sell setup here a couple of days ago with our red sell bar there. So if I right mouse click over our red sell bar, do analysis, you can see this then puts our position sizing on. So what do we mean by our position sizing? Well, what we do is we take a percentage risk, which you can see here is 0.5% up at the top there, on your account. Now here, this is just a sample $20,000 account. So 0.5% risk on $20,000 is a risk of $100. So what does that mean? It means basically if you enter the trade at your entry level, which you can see here we had short at 49.39, and then you exit at your stop level, in this case it would be 50.31, we want this loss to be $100. Now it's interesting that I start off with talking about losing and losses and losing trades, and that's the important thing with our approach at MTPredictor. Is what professional traders do is that we look at the downside and the risk side first and foremost, because this is absolutely paramount to any successful trading approach. The profits take care of themselves over time. What you have to do first and foremost is keep your losses small and stop your losing trades quite so much. This is why professional traders, they focus on what they can control, and what they control is their entry level and their stop level, in other words, their losses. So what do we do then? Well, we say, right, we only want to lose $100 on each individual losing trade. So from that, we know our entry level, we know our stop level, so we can come back and then work out how many shares, in this case, or if you're trading futures contracts, or if you're trading Forex lots, how many lots, contracts, or shares you'd need to trade to keep your loss if that turned out to be a losing trade at $100. So that's what we do to start with, and that's why we use the percentage risk on an account size, and then we reverse back the number of shares you'd take on that, because we want the losses to be the same each and every time. In other words, every single trade you put on, we want every loss to be consistent. In other words, small and under control. Why do we want that? Well, because then when you come onto the profits, What we want is over time, as if this trade gets down to the target, we want the profit not to be large just in dollars. We want it to be large in relation to the initial risk. We want these profits to relate directly to your losses. So only then can your profits be large in relation to your losses. If you just take a fixed number of shares each time, say you buy or sell 100 shares or 200 shares or however many, then depending on where you enter to where your stop is, sometimes your losses can be big, sometimes your losses can be small. When you get to your profit target, sometimes the profits can be large, sometimes the profit could be small, but the problem is they don't relate to each other. That's why we do everything in relation to the initial risk. Now, you may have a larger account. So if you go to Tools, Accounts and Risk, you can set up all different size accounts. So let's do a new account here. Let's say you have, I don't know, $150,000 maybe, or perhaps 150,000 euros or British pounds. So you can set these up in all different currencies as well if you wish. So let's keep it at 150,000 US dollars. Perhaps you're trading a larger fund and you do okay. So there you have a larger account. So to apply and then okay. And now this is available from your drop down here. So now if you're using this, oh, I didn't give it a name. You should have given it a better name than that. So this is my new account. So here now, suddenly for the same risk, 0.5% on $150,000 is 800 shares or 815 shares. So you can actually change that depending on what your risk is. Or say perhaps if you've got a large account, your risk is a bit too big, you can then come down to Accounts and Risk, go to your risk profiles. If I move this across, I'll show you what happens. Let's move the risk down to say 0.1%. So if I do apply now, you can see how that drops the number of shares down to bring your initial risk down. Just having a look at a question from Kevin. Yeah, Kevin's made a very good point. He says that when he first started, he was only trading the number of shares based on his whole account size. So what happens now is when you look at your entry and your stop, suddenly you could be trading quite a few shares. In other words, you could be trading more shares. And he says that makes him nervous. But the difference is because if you think about it, when you actually place a trade, you're only ever risking your entry to your stop. In other words, you're only ever risking what you're going to lose. In other words, you're not going to lose the whole balance. Now, I must admit, I went to a seminar many years ago where they were talking about options, and they were trying to justify that options were a lot safer than trading underlying futures in that case. And they were saying because when you bought a call or a put, you only risk your loss to the actual value of that call or the put. But what they didn't understand, and I find it hilarious when you go to a webinar and you tend to know more than what the person speaking is talking about, is that in reality, you're never ever going to want to lose more than what your entry to your stop is. So the initial risk is only ever kept under control like this. In other words, you're not going to let your initial trade go to zero, if you know what I mean. So that's why when you look at this in comparison to trading options, it's no riskier because you're not having an unlimited open risk here because you want to come out quickly. Now, of course, Kevin made a good point is because this then can actually get you rather nervous by actually trading a lot of shares. But then again, what you can do is if say you've got a $150,000 account and you want to trade less shares than that and the 0.1% risk doesn't work, well, then what you can do is you can set up a slightly smaller account. You can do a bit of different calculations. You can work it out yourself and say, well, if I only want to trade less shares, if I had a $50,000 account, to apply and do okay, and then there's your $50,000 account. You know, even though your account is 150,000, you could trade it as if it's only 50,000 and therefore have your loss a lot less as well. It just depends on what your risk profile is. But this is the whole concept we're trying to get you to do, is we're trying to limit the loss to a set value. And now this is not just calculated by me. If you want to learn more about position sizing, probably the best books are by, let's have a look. Hang on a second. Two, three. Testing 1, 2, 3. Can you all hear me again now? Yeah, I think I just hit my mute button on my microphone. Sorry about that. That's when I was turning around trying to read the title of the book. Right, so that's all well and good, but some things can go a bit wrong actually. And I want to look at the example here, and if you're trading daily stocks in particular, because if I use our trading mode and I go back to here was a particular trade on Liberty. So again, the position sizing. We do the position sizing here. So here you can see, again, varies the number of shares in this case, based on your percentage risk and whatever the account size is, whatever account size you've got there, and your entry level and your stop level. But what can happen is if we go forward a day, here's our entry level at 25.47. So you place your orders in there. But then the next day it gaps up on the open. Do you see that? It actually opened at 25.57 rather than the order 25.47. So of course, what happens then is you've got an order to go long for 89 shares. So of course, if you've got 89 shares in here, then your position sizing will all go wrong. So what do you do in that case? And this is something that's perhaps good to tackle now, is that there's a couple of things you can do. And this is why we allow you to grab and drag these risk reward lines. So there's two things you can do. Is you can either grab the line, you can see we take it up here to what the entry level is, to there, and that then, still keeping the initial risk at $50 in this case, that then brings the number of shares down, so you can then sell some shares to keep your initial risk, in other words, your potential loss exactly the same. But also that has the problem of, do you see what happened here at the risk reward? Look at this risk reward number as I drag the entry level up and down. The risk reward at the target went from 2.4 down to 2. So in other words, your potential profit is less. So of course you don't want that over time. First and foremost, you want to control your risk. Yes, that's the tick, but you don't want to then reduce your profit if you get to the target. So then what you can do is still keeping your initial, as 89 shares, wasn't it? Your initial 89 shares, but what you can do is then bring your stop order up to then replicate your 89 shares again, which was about there, wasn't it? Somewhere. 87, 89, let's call it that, as close enough. But do you see it then brought your risk reward back to the 2.4? There it is. back to the 2.4. So what you've done, basically, you've still kept your initial risk at $50. You've still kept your number of shares at either 89 or 92 shares, or thereabouts, but you've brought your stop level up to keep the whole equation exactly the same. So that's why we've allowed you to grab and drag the entry levels to take account of situations like this when you get gaps on your opening trade. So does that make sense again? And it's probably something that's worth talking about today, because that's a topic that, or something that can happen when you're trading end of day stocks. So remember, first and foremost, what we want you to do is to control your losses. That's exactly what we want to do. The first and foremost is to keep your losses small. And we do that by our position sizing to vary the number of lots of shares based on the entry to stop. So every single trade you take, your loss is kept at the same percentage of whatever account you have. So those risks or those losses are kept the same. That's the only way you can truly be consistent across everything you do. In other words, you keep your losses small, but those losses are kept consistent. And then over time, so if we take this one off, you see there you go up to the first target there. Over time, profits should be large, but not just large in dollars, but large in relation to the initial risk. That's the whole key to actually making money overall. And it's what most amateur traders never, ever understand by using fixed lots, is they never understand that to actually truly have big profits and small losses, they have to be related and they have to be consistent across time. Otherwise, what's big? What's small? It's not related to anything. This is why the whole thing here is the profits. That's why we talk about risk reward units, and not just there arbitrarily. It means the profits are directly related to the losses. So when you make this profit here, this would be 2.5 losses. In other words, 2.5 times the initial risk, 2.4. I know it's close to 2.5. So I think Kevin has really sort of understood it now, and I think it's probably a good topic to go over here to really bring this home, why we do the position sizing and why it's so important. And it's amazed me that so many amateur traders never even touch on this topic. They pay lip service to say, oh, I'd like to keep my losses small and profits large. In reality, they do the opposite. They come out as soon as they've got a small profit. They then let their losses run, so the losses are big, but they've got no relation to them at all, because they're trading fixed lots, either 100 or 200 shares a time. So nothing's related to each other. It's just balmy, really. So hopefully that makes sense to everyone, and hopefully everyone's happy with the discussion we've had here, and also happy about what you can do when you get gap openings to then keep your initial risk the same, and also then your profit RRs the same as well. So in other words, you can adjust your entry and adjust your stop level to basically put you back in the same position that you had to the start. Right, looks like a lot of you are really enjoying that, so that's good. Right, I want to skip over and have a look at our VS setup, if that's okay. So what I'm going to do now is I'm going to this is a handy thing with our standalone. You see, I have this saved as a layout, you can see here. So this is a layout with my end of day data. So what I can do now is I can now go to layouts, and I can open a completely different layout. And obviously I want to save the current layout as I've done it. And this opens a completely different layout, but with a different data feed. This is moving on to my real-time data feed. And here it is. Here's my real-time layout with all my USE minis and all those things that you're normally seeing, but it's all saved there and brought up as a completely separate layout. So it's a nice way to change from, if you're looking at end of day stocks, I was a second ago, to then suddenly bringing up some real-time data on a real-time layout as well. Just keeps things nice and simple. Right, so I want to look at this VS setup and what it is. VS stands for, very simply, a volume spike. So what is it and why do I like it? Well, let's have a look and go back in time to back here somewhere. This is a 3-minute chart of the ES. By the way, all the things I talk about, it doesn't matter whether you're using short timeframes, daily charts, longer timeframes on Forex, all the same kind of principles work together. So let's have a look at this VS setup. Right, here's the market a little bit earlier. So what we're looking for is we're looking for the market to make a move beyond a psychological important high or low. Now, as we got to about lunchtime here, the previous or the low of the day so far was here. This was an pretty important psychological low. Most amateur traders would see this as a level to potentially sell by, particularly as the market's dipped below it, come back up again. So let's now see what happened here. On this bar here, the market made a dive below the important psychological low. In other words, low here. In other words, it broke down to new lows. And obviously, the reverse is the same if you're going to new highs. So if you're an amateur trader, if you have a break of a big high or low on high volume, if I look at the VS here, you see, skip back a bit, the volume here has actually increased. So most amateur traders would look at this and say, oh yeah, a break of a previous high or low on high volume. In this case, it would be selling. Obviously, if it breaks to new highs, it'd be buying. And they say, oh, selling. I like that. We've now made a breakout. Classic sort of technical analysis technique, a breakout. Therefore, I'm going to go with it and go, with the breakout into the new direction. But if we go back a bar, we have an important, very important tool. We have an MTPredictor here. It's our decision point. Now remember, these go on the chart in advance. If I go back to this prior low, that would be on the chart in advance. So that would give you an area of potential support in this case on the chart before it gets there. So what happens now when suddenly you get this high volume bar that goes down into our DP support? Amateur traders are saying, whoopee, let's sell the breakout. We're looking at this and saying, hang on a second, we've now made an area of potential support. I say the word potential because we know that nothing's 100% in the markets. That's why it's a decision point, not a support level. It's a decision point. So what we do is we look to the next bar. Okay, this is the important point. First and foremost, the bar breaches an important psychological high or low on high volume. We then move forward one bar. Look what happened here. The market then reversed back up again. So if you're looking at this, what do you think the volume in the previous bar was actually telling us on this bar here? Do we think that this volume was actually, as the amateurs thought, new selling? In other words, the market's going to move to new lows? Or do we think that something else is happening? Well, because the market has failed to follow through, in other words, it has gone down on high volume. There's your high volume bar on this VS here. It's then failed to follow through. What this actually means, it means that the professionals are now stepping in. The professionals are now taking the opposite side. The professionals are now selling to the amateurs who think it's going to go down, and they're starting to go long. In other words, they're going to the opposite side of what the amateurs are doing. In other words, this is a potential fake out. You've probably heard the word fake out if you've read any books as well. But what the professionals have done here is they've faked this out to get the amateurs on the other side of the trade. Now, if we're sitting here, which side do we prefer to be on? Do we prefer to be alongside the amateurs, who 97% of them lose, or do we prefer to be on the side of the professionals, who tend to win the most of the time and take the money off the amateurs? Obviously, we want to be on the side of the professionals. So let's turn training mode off and see what happened. Now, if you look at that on the ES yesterday, that actually turned out to be the very low of the day. So of course, that's the last place you want to be selling. It's amazing how many people, if you're looking at amateur traders, who've said they sold the low of the day or bought the high. But professionals are doing the opposite. Now, normally the market tends to go with the professionals because the professionals have got the big money and they tend to then move the market very quickly. So if I go back and do our position sizing on this, right mouse click over the blue buy bar, do our analysis. Again, here's our position sizing. In this case, less than 2% of a sample $20,000 account. So our position sizing takes care of the number of contracts you can trade. I mean, if you're trading your big account, that you know, 150,000, you could be doing lots of contracts, but we'll keep it at the same here. So again, our initial risk is kept constant and under control, no matter what markets you're trading, whether it's futures, whether it's forex, whether it's stocks, everything is kept consistent and under control on your losses. That's the single most important thing we tend to do. And over time, we're hoping to then have profits. If the market gets up there, the profits are large in relation to the initial risk. Now here it didn't make it. So this again is a good example to show, because if you guys who've been with us for a while, you'll know that I like to show examples that aren't absolutely brilliant. I like to show things where it's the real life. I like to show things where things don't work out absolutely perfectly, because that's what real life is. And there's nothing worse than gurus who show idealized examples that never work out. So in this case, was the low of the day. We actually it came off, but it didn't get the highest target. It got to just about 2-hour profit, which is nice, but that's all the market had to give. So do you see the concept behind this? So this isn't particularly Elliott wave patterns. This is not based on my isolation approach to Elliott wave. This is purely and simply based on what professionals are doing, and my experience in 32 odd years in the markets, and actually seeing what professionals do, and developed a trade setup based in and around a fake out that gets you in the opposite side to the amateurs, to gets you on the same side as what the professionals are doing when they tend to move the market in the opposite direction. And it's amazing how many times a VS setup will be the high or low of the day like this. It really is. So a VS setup is one of my favorite trade setups, because it does tend to go in the direction of the large degree money. But do you all understand and see what this VS setup is, and understand how it's first and foremost a break of an important psychological high or low? Now that's why we want to do it. I keep saying important psychological high or low, because here this bar broke below the low of the day earlier. So this was a good trade setup. If we look at the NQ, the VS setup here was based to break, oops, I didn't want to do the high, I want to do the low. A break of that, if I can get my mouse correct, sorry about that, third time lucky, a break of that bar. You see that? It broke through that particular bar. Didn't want to do that, want to do a DP. You see, it did the VS around that bar. Now, that wasn't the important psychological high or low, was it? That one was. So this is why I say to you, look which particular pivot the VS setup is in and around. And we've only just calculated to go around the previous pivots. Kevin says, why? Well, the important thing is because the more important the swing pivot is that it's breached, it's getting the amateurs in the wrong direction. So the amateurs here won't be saying this is an important swing high or low. They're saying this one. So they'd be looking at this low as the important psychological low. I keep doing the high rather than the low, don't I? But you see what I mean? This is what the VS setup is. It's the breach of the important psychological high or low where the professionals fake out the amateurs. In other words, they're looking to move the market beyond a really important high or low, trick all the amateurs, get into the wrong direction, then move it sharply in the opposite direction. So this is why you take the DP off the major pivot high or low, so it would be that level there, and of course that VS setup didn't unfold at that level, where the ES it did. So do you see that that's why I talk about breach of an important psychological high or low, which is like a major pivot and not just a minor swing high or low. And that's something that people who don't come into these webinars and don't listen to my trading sometimes get caught out by. So that's what you need to do, is look at this in relation to what the amateur traders would be and see what pivot is actually faking out at. And as you can see, it does actually turn out to be some nice trades, or very often. Now, I know some of you are going to say, well, hang on a second, that's not at a major, a higher time frame support level, because if I go out to the 15-minute support, there was no 15-minute support on regular trading hours or the regular trading session there, but this is why I keep half an eye on the 24-hour session. It's what I've talked about or mentioned occasionally, is we work off the regular trading hours normally, because that's what we call the day session. You see now the market's just opened and it's just started coming in here. But if you look at the 24-hour chart, this is on the E-minis, the 24-hour chart, this was where the 3-minute VS setup was. That was the last 15-minute. This is a 15-minute chart, by the way. That was the last 15-minute pivot low on the 15-minute chart on the 24-hour session, and you can see how it caught the low. So now if I draw the 3-minute chart here and I go all the way back, there you go. Can you see how that VS setup, which if I drag these side by side, that VS setup there is at 15-minute support, which is the same VS setup there. So this is why sometimes people say to me, you know, which time do I use for the USE minis? Primarily the day session, which is the regular trading hours or RTH trading hours, but it's nice to keep half an eye on the 24-hour chart as well. And this is a perfect example of where the 24-hour chart gave you that extra little bit of information that we're at higher time frame or 15-minute support to help you, give you a little bit of extra confidence in on that day session only. And interesting enough, if I put the analysis on here, you can see that actually came up and reached its target of 4.1R or 4R just after the market closed. So that was where the market closed, about there. In after hours trading, it just went up and just hit that level and actually made its profit target quite nicely. By the way, I hope you guys know how to move these tabs around like I've just done in our standalone. It's really quite nice because you can grab these and stack these as you want. You know, you can do that. You can bring it down to there to have charts like that. You know, you can have them tabbed in here. You know, you can just move them around and stack and tab them, you know, as you want. It really is quite sneaky. And then obviously when you change the size here, everything moves and stays in all together, all quite nicely. And then you can have the whole lot in a workspace. So, you know, your workspace is all kept there quite nice as well. And if you wanted to, you can take this chart and you can go off and float it. So there's a totally floated chart. Wherever it's gone. Oh, it's gone back to there. If it's a floated chart, it floats like that, and you can take it off to another monitor if you want as well. So it can go off to another monitor. I'll just bring that back into the main one in there. So there's lots of things you can do with the layouts of MTPredictor 8 as well. Greg wants to know the DP trend. On the 24-hour chart, the DP trend was grey, and on the day session only chart, the MTP trend was grey as well. It actually went grey, so it was in the process of making a reversal. If you look at this and look at the DP here, you see it was actually a major DP. In other words, it was coming off a major pivot at that particular point in time. So the MTP trend was grey. So yeah, you know, you weren't against a red MTP trend. If that makes sense, then Greg. Yeah, so hopefully you've enjoyed having a look at the VS setup, and it was nice to review that because that's one of my favorite trade setups as well, because it gets you in the direction of the professional money, and it's normally a big move associated with that. I mean, sometimes it doesn't. That's why I chose that example to review it, because sometimes it just doesn't work out, and that's the fact of real life trading. The other favorite trade of mine is the W3 or wave 3 trade setup. As you know, because that's typically a wave 3, which is typically the strongest and longest in a completed 5-wave sequence. Right, let's have a quick look at oil now. Open a workspace I had saved, gold and crude. Let's have a look what oil's done. Yeah, this is oil. As you all know, this was yesterday when the attack happened in Saudi Arabia. Oil spiked up. So what was MTPredictor saying? Well, first and foremost, our MTP trend was blue on the daily chart. This is the daily chart of October crude here at the moment. October crude, the one we should be in for you guys who trade crude, or should we be out to November yet? Probably not, it should still be in October probably, but this is October crude. It jumped up, but our MTP trend was blue. So, you should be on the long side for trades anyway. And if you actually now come down and look at a weekly chart, by the way, if you ever see the MTP trend orange like this, it just means there's not enough data to calculate it. We need 10 major pivots, swing highs and lows, so 5 highs and 5 lows for our major pivots to calculate our MTP trend. If you go to like longer term charts, like a weekly chart, sometimes you just haven't got enough data and therefore it can't calculate. So that's why it's telling you it hasn't got enough, and that's why it's orange. In this case, you can't use the MTP trend because it's just not enough data. But interesting enough, on the patterns, there was a W3 trade setup, which was suggesting that perhaps, if anything, we should be looking at potential rallies in crude as well. So, well, at the very least, you wouldn't want to be on the short side. You'd be preferring the long side. So if we come back to the daily chart, what happened with it? Well, it gapped up. Where did it gap up into? There's our previous high. Right mouse click, do DP, bang, straight into our DP before declining down and going back up again. If it goes beyond this, our next resistance level would be the DP of the previous high there, up into that level there, which would be just under, what's that, about 68, 69 level, up around there. So that would be our next major resistance if crude does go beyond this particular resistance level. But just very interesting the way, the media was sort of panicking and saying, oh no, crude spiked up 20%, end of the world, and oh dear, no one ever saw it, and all this kind of stuff. MTPredictor, we were biasing towards the long side on the analysis there anyway, and smack bang into that resistance level yesterday. So I just thought that was interesting to have a little look at crude on that there as well. I haven't looked at any real short-term charts. I don't tend to look at any short-term charts myself on crude, but oh, here we go. Interesting enough. There's a VS sell there that looked like it caught the high really nicely. And the other favorite trade setup, W3 trade setup there, that hasn't reached its main target, but on the long side, obviously it's not one you'd like because the MTP trend was red, so probably not one to take. But there's a classic example of a VS sell, exactly what we're talking about. You see here, there's 1, 2, 3 highs there. So this bar here pushed beyond those psychological highs. Do you see that on high volume? Most amateur traders would be looking at this and saying, woohoo, we've gone through a fairly obvious level there, haven't we? A fairly obvious level at those highs. If I put a high tag on there. There's a fairly obvious high there, level there. So you've gone straight through that level. They're going to be buying. There's your high volume. The very next bar, it fails to follow through. What do the professionals do? They move it back down again. There's your position sizing. In this case, one contract down into your first target for a 2.4-hour profit. So a good example of the VS setup on really short-term crude oil trade, but exactly the same idea that we were looking at on the ES, where the VS setup is a move beyond an important psychological high or low that reverses back again. So hopefully that's a good example, and you can see that. And if you're an amateur trader and you go back to here, just take yourself back years and years and years. You'd look at this and you think, oh, there's a high level there, 1, 2, 3 moves. We've gone straight through it. Volume's increasing. I'm going to want to buy here. I'm going to want to take this. It's going to go to the moon. What happens the very next bar? It fails to follow through. It reverses back. It's the professionals saying, actually, no. We're now getting short. All the amateurs are getting long. What happens? We then get a move back again in the opposite direction, with all the amateurs getting stopped out as the professionals make a nice quick move there. So good example then again of the VS trade setup there, this time looking at a very short trade of crude oil. Right, are there any questions now? I've sort of run out of time a bit, but hopefully you've got a little bit of time for any last questions. And hopefully you've enjoyed today's webinar where we had a good look at position sizing. We had a good look at the daily stocks and using position sizing on daily stocks and why we do the position sizing based on Van Tharp's work and definitive guide to position sizing. So, Kevin, I know that you're quite an academic, so you'd probably like a good read from another academic. So Van Tharp is very much that, and he's done a huge amount of work on position sizing and lots of different position sizing models that he goes into, and the reasons behind it, and all real, really heavy stuff there. And like I say, MTPredictor is reviewed on that particular book as well. Greg, I just use a standalone here because this is what I was working with today. Last week, I was using the NinjaTrader 8 add-ons. I mean, all the same tools. All the tools I've been talking about here are in our NinjaTrader 8 add-ons as well. So whether you're using NinjaTrader or whether you're using your standalone, you can do exactly the same as what I've talked about here. We have exactly the same tools in NinjaTrader as we do as our standalone. So if you're using NinjaTrader already, stick with NinjaTrader. That's absolutely fine. All right, glad you all enjoyed today's webinar. So that's absolutely great. So there's the recording going to go up a bit later. So you can review that and go over that, and particularly go over the VS setup, because that's one to keep an eye on. And you see here, very often it will catch the very high or low of the day. People always say that it's impossible to catch the highs and lows of the day. Well, here's a trade setup that very often does it. And it's backed on exactly what professional traders are doing by moving the market in the opposite direction and doing a fake out. That's what it basically is. It's basically catching a fake out in and around important psychological high or low. That's the important point. Look at what pivot the VS setup is failing in and around. In other words, it has to be an important psychological high or low, not just a small or minor pivot. They're the ones that tend to work the best. Right, so I'm glad that you've all enjoyed today's webinar. It's been great fun teaching it today. I enjoyed covering the topics that I did today. So I'll put the recording up a bit later. So let's see where the markets go over the next week, which should be interesting to see if anything does actually happen with this oil situation, and anything does obviously happen with the ongoing trade wars with China, to see whether we can get any moves on the US stock market. And obviously we keep an eye on oil. Then in the background, obviously I haven't even talked about Forex today, but basically our Prime Minister's has basically been taken to court, into our highest court at the moment, to see whether he was legally or legal in proroguing Parliament or suspending Parliament. That's going to be going on for the next 3 or 4 days, with an announcement or ruling on that probably early next week. And obviously that could have a big effect on our currency, the pound, depending on what's going to happen relative to our Brexit stuff. So there's interesting things going on with currencies related to that, and particularly pound-related cross rates, and obviously crude and stock market could have big moves as well. So lots of things to keep abreast of as the next weeks go on. But remember, first and foremost, keep these initial risks and losses small. That's absolutely paramount. The only thing you can control is your entry level and your stop level, and the number of lots, contracts, or shares you trade. The rest is up to the markets. Keep those losses small, and then over time, hopefully have profits that are large in relation to the initial risk. Do that, and you'll be on a lot better footing than 97% of amateur traders, because they tend to just end up losing. Right, so have a good trading week, guys, and we'll see you all again next week. Any other questions, drop me an email, steve@mtpredictor.com.